There's been some weak data coming out of China. Growth's not been what they expected post-COVID bounce. And they've, in turn, cut rates.
Yep.
How do you see those were they shock rate cuts, would you say? And how do you see them affecting European and US markets?
All right, interesting. Because, I think China, when it came out of COVID, there was this real euphoric belief that now we're going to see the resurgence of demand for raw materials, iron ore, copper, oil. It didn't happen. And then the market got euphoric again about, well, because it's not happening and the recovery is so slow in China, they're going to give us one of these massive stimulus packages that we've seen before. It's not happening. So what I think they did is that they've tried to tweak the economy with 10 basis point cut in interest rates. Short and long end. But to be honest, it's not much. And I don't think the market is happy with that at the moment. And we've still seen, what was it last week? Nearly 4% fall in oil, 2 or 3% fall in copper, silver. And I think, these signals are all related to weak global growth. And I think China data now is so much more important than it was because it was distorted so much through COVID. The reality is that the economy is weak still. Yeah. So this big boost that the markets were expecting just hasn't happened, and it's not going to happen unless they do something. I don't think that they are prepared to be as aggressive as they were in the past. So therefore, that leaves markets open to disappointment. And interestingly, we've seen the Aussie rollover. We've seen the commodities looking a bit softer. And some of these commodity currencies could be in a bit of trouble here because they had a good rally over the last couple of weeks on a lot of this and domestic issues. But, I think we've got to be careful because the connectivity between the likes of Aussie and the euro to a weak China are quite clear. And, the euro's fallen, weak data, weak China, Aussie's fallen, weak commodities, weak China. And I think, every now and again, this takes over what central banks are necessarily doing with rates. So it's a fascinating time in foreign exchange markets. And it's not just about trading equity markets. There's so many good things to trade. And the Capital.com platform is absolutely fantastic with the sort of broad brush of products it's got on it. So I do think there's some real opportunities to learn about how some of these things are interactive.
Speaking of commodities, what's your outlook for gold, silver? Gold's one of our most popular instruments traded. How, in this kind of continued hawkish, high rate environment, we know the gold price and interest rates are quite correlated, and weak data coming from China. How do you see the price of gold in the kind of near term?
Well, first of all, touching on silver, it's slightly different to gold. It's more of a raw material, if you like. It's used more industrially than gold is necessarily. But if we talk about gold, if we take a step back, gold had this big rally during the banking crisis. So this was a systemic risk issue. When we get those real systemic risks in markets, gold always does well. Doesn't matter what the dollar's doing, doesn't matter what stocks are doing. If they think there's a banking crisis, gold always does well. Gold has started to fall over. And the problem is that the banking crisis has moved to the back burner. I wouldn't say that crisis is over, but I would say that those late to the party got squeezed out because it settled down somewhat. We are still seeing money moving from deposits into money markets. There is an alternative to low deposits at banks. Banks are having to stick these deposit levels higher, which is eating into their profitability and their margins. So the banking crisis is not necessarily done. I think people are worried about the weaker lenders, and I think that could make a headline again. But at the same time, the regulator is going to put more pressure on these lenders, which means tighter credit conditions, which could slow the economy. So I think, gold at the moment, when things go quiet, gold all of a sudden reverts back to being dollar-based. So when the dollar does well, gold is inclined to fall. And with all commodities based in dollars, there is a dollar issue in there. But for gold to really spike back up to the highs, I think we need to have a few nasty headlines of risk aversion, not necessarily just the banks, maybe Russia and Ukraine, who knows with what's going on there. So I think, there is a danger that gold could actually rise again on risk aversion elsewhere.
Thank you for watching. Don't forget to like and subscribe and join us next time.